All anyone is talking about right now in the real estate world is the legal settlement with the National Association of Realtors. But nobody is talking about how it specifically relates to the mortgage world when it comes to obtaining financing in today's real estate market. That's what I'm here for. I am actively closing a high volume of transactions every single month. So this is going to be a no BS video. You are getting it directly from the horse's mouth on what's actually happening in the trenches. Not all the other BS that's out there right now from politicians, attorneys, and the wannabes. And first, I want to lay some groundwork on what the NAR settlement actually is because so many people are getting it wrong right now. The National Association of Realtors, NAR for short, recently agreed to settle a legal dispute for, actually, increasing rules to promote fairness in real estate transactions. And simply put, three main things changed in the real estate world because of this. One, increased transparency. As I just mentioned, attorneys want real estate agents to be 100% transparent with what is going on between a buyer and a seller in terms of compensation. This is supposed to make buyers and sellers more informed on their decision. Two, the thing that has gone absolutely the most viral is that there is no mandatory compensation for a buyer's agent. This means that real estate agents can no longer require a property seller to pay them a commission during a transaction. And side note, before this settlement even happened, a seller could technically pay a buyer's agent $1. Now with this ruling, it essentially means that, hey, they're no longer required to pay that $1, they can pay $0. And then thirdly, the big one, the disclosure of real estate commissions. Real estate agents must clearly disclose their compensation, not only at the beginning of the transaction, but all the way throughout it. Funny story, actually. I've been originating mortgages since 2018, and I had no idea for like the first 2 years I was in the business, I had no idea how a buyer's agent was actually getting compensated. Because I was writing these loans, I was seeing the buyer's actual financial situation going, all right, their down payment and closing costs are 20 grand. They've literally got 21 grand in the bank. And I had never looked at a final settlement statement or a final closing disclosure or something like that that actually showed the buyer's agent's commission on it. So I really had no idea how they were getting paid. Now, they were getting paid from the seller on every single transaction, but that just goes to show how important these changes are. I was in the business and I still didn't understand how a buyer's agent was getting compensated. So when you take the average person who is buying and selling real estate, they really don't know what's going on. To paint the picture further, both buyer's agents and seller's agents were getting compensated prior to this lawsuit by the property seller, right? They're selling their home, they've got $100,000 in equity, and out of that equity that they're getting, they're paying both the buyer's agent and the seller's agent. Now, as I mentioned, the seller is no longer required to pay that buyer's agent's compensation, which means if they don't, the buyer is actually on the hook to pay their agent their compensation. So hopefully we're all on the same page now. That is not what this video is about, but I wanted to make sure that no one was left in the dust as we translate all of these changes into how it impacts the mortgage side of the business. And funny enough, three things have changed. The first major change in the lending world is interested party contributions. The max IPC percentages for every single loan program does not include agent commissions. There's a max amount of concessions that are allowed to go towards the buyer's agent's closing costs depending on the type of loan they're getting. This is to avoid fraudulent and kind of shady activities or shady ways to structure a deal that puts the lender at risk. Max contributions can actually be pretty small depending on the loan product, so if a buyer needs to have all of their closing costs paid for by the seller and also pay for their buyer's agent's compensation, these loan programs might limit them. So let me give you an example. Let's say someone goes to list their home and they say, this is great. I don't have to pay a buyer's agent compensation anymore. Instead of paying 6%, I'm going to pay 3% in commissions. And they go list their house with their homie for 3%. It then sits on the market for a while because a lot of agents aren't showing the property, or a lot of people just don't want to buy the property, or whatever it might be. So then the seller starts sweating and goes, man, I really need to get this property sold. What can we do to sell this property? Well, now that seller can start entertaining offers where they say, hey, look, I will pay for your closing costs and I will pay for your buyer's agent's compensation. So instead of me just giving you 3% for your closing costs, I'm going to give you 5 or 6% so you can cover your closing costs and your agent's commission, and we're all happy. So what ends up happening at the end of the day? Well, literally this lawsuit would have changed effectively nothing because the seller is still paying for all of those costs involved. The big change now is that it's all negotiable and it all depends on the property. If you have a great property at a great price with a lot of interest and a lot of high net worth buyers who can afford to pay their buyer's agent, then great. The seller shouldn't be on the hook to pay the buyer's agent's commission because they don't need to. But most homes in America are going to need to pay for those buyer's agent's commission. Let me just tell you, most buyers are broke. But anyway, the second change when it comes to the mortgage world is additional documentation. Buyer-broker agreements, or potentially seller compensation addendum. All transactions in real estate essentially acquire more documentation or more forms now to, again, make sure the buyer is well informed. And not only the buyer, but also the seller. Because of that, we have some additional addendums or agreements that us on the lending side need to be getting up front. I'm not going to go over the details of each form because that's a real estate thing. This is a mortgage video. But what you need to understand is that these forms can drastically shape the outcome of a transaction. These forms need to be given to the mortgage company right away. Because what's gonna happen, and what's already happening, is a lot of agents or buyers and sellers aren't giving these addendums to the lending company, and we have to disclose everything. Literally every single penny. We've always had to disclose everything. So if we don't know that there's a $15,000 agent commission that is being paid by the seller or the buyer, we're not gonna disclose it in our initial documents. And if we don't disclose it, that means we're going to have issues later down the line. Let's say, for an example, the buyer is on the hook to pay, let's just say 1.5% of the commission. That ends up coming out to be $5,000. Well, if we don't have that form saying that up front, we're going to underwrite our loan as if the seller is paying for the buyer's agent's commission. We're going to get all the way down into closing. Everything's going to be great. We're going to get our final approval just barely because, again, remember, most buyers are broke. We're going to get to the closing table. The agent's going to say, hey, where's my commission on here? We're going to say, oh, we didn't know that the buyer had to pay your commission. So now we have to go back to underwriting. We have to resource more assets so that the buyer can actually afford to pay them. And it's just absolute nightmare. Delays closings, burns bridges, is super awkward with people. It's just a nightmare. So it's really important that the mortgage company receives all of these additional documentation up front to avoid these big surprises at the end, which will happen and is happening, and it is absolutely blowing up deals in the real estate market right now. And then lastly, the biggest question that I get asked all the time with these new changes is, hey Sean, can we roll the buyer's agent's commission into the loan amount? Sad that I even have to touch on this because us Americans literally try to finance everything in our lives. It's like, oh, we can't afford to pay something. Well, let's just borrow and let's just charge it. I digress. But the short answer is no. You cannot finance the buyer's agent's commission into your loan amount. I'll say it again. You cannot finance a buyer's agent's commission into the loan amount. As much as everyone wants to, you can't. We are already max leveraging all these properties in America with loan amounts on collateral that's not super great. So if we're already lending a loan at 90% loan to value and now we need to add a 3% commission on top of that, now we're literally loaning at 100% loan to value, and that's what's going to cause another housing crash, which we do not want, let me tell you. But part of my job is figuring out solutions to really tough problems. And if we have a buyer who really wants to buy a specific house where a seller is not paying their agent's commission, well, there are some ways around it. We can essentially increase the price point so that the seller is still netting the same amount. However, now they're paying the commission through the sale of the transaction. Our loan amount's a little bit higher, so we're not directly one-to-one financing the commission, but as long as the property will appraise for that higher price point, we can make it happen. And I know that might be confusing to a lot of people who are not in real estate, so let me give you an example. Let's say you're buying a home for $100,000, and as the buyer, you're putting down 5% for your down payment, and the buyer's agent's commission is $3,000. Well, you really have two options in this scenario. You can buy the home for $100,000, put down your $5,000, pay your closing costs, in addition, pay your $3,000 buyer's agent's commission. So taking closing costs out of the mix, that's you paying $8,000 at closing. $5,000 in your down payment and $3,000 to your buyer's agent. Or the second option, which is a little more creative, is you can actually buy the home for $103,000. You can put down 5% of that, which is $5,150. And then you have the seller pay the $3,000 to your buyer's agent in the form of a concession. So now they're still netting the same amount as if they were selling you the house at $100,000. Yet your financed amount is $97,850, and you're only out of pocket your down payment, which is the $5,150. Yes, you finance more and your monthly payment is a little bit higher, but your out of pocket cost is barely any higher. And the best part, which is the point of the solution, is that the seller nets the exact same amount. The key though is that the property must appraise, and we are likely going to see a lot of these possibly not appraising. And I don't always recommend that strategy, but that is something that you can do if you're getting a great deal on a home or you think it will appraise. and you won't be able to get the seller to pay for your agent's commission. So I don't always recommend someone do this. However, I am all about transparency in my line of work, which is kind of rare compared to the rest of the industry. I will tell everyone the options and the solutions and the creative ways to get something done. I don't always recommend they're the best financial decisions to do, but if someone knows about everything and they're still willing to make that decision, I have no problem doing that loan. I have no problem funding that. I am in the business to literally write bigger loan amounts. Bigger loan amounts mean we bring in more revenue, means everything's greater in our world, but that doesn't always mean it's the best financial decision. And I always inform my clients of what the best financial decision is and what the other options are, and whatever they choose is what I'll do. Those are really the main changes from the NAR settlement when it comes specifically to the lending side. Now, this is where I give a little shameless self-plug. I started X2 Mortgage to have a much more cost-effective mortgage process. So with these changes, that is super important. We don't charge any lender fees at all, which means a buyer can save right off the bat $1,500 to $3,500 when they're actually going through a transaction on a home. With the freed up cash of not having to pay any junk fees, you can now direct some of that cash to a buyer's agent's commission if the seller is unwilling to. By effectively lowering your closing costs, not even dependent on the property itself, you as a buyer are way more competitive and in a much better financial situation than anyone else in the market just by working with a cost-effective mortgage company like us. I'm always just trying to give the people we work with and the people in our circle an upper hand against everyone else out in the real estate world. If you have questions or you want to speak to a loan officer directly about your specific scenario, just head over to our website, x2mortgage.com, or give us a call or shoot us a text. Shameless plug over, video over. Hopefully this was helpful. See you in the next one.